Hello, everyone. Welcome to the presentation of Altamir's annual results. This is the company's 29th financial year. I'm here with Maurice Chéniaud, President and CEO of Altamir Gérance, and Eric Sabir, our CFO. The floor is yours.
Thank you very much, Claire. So I'll spare you the presentation of Altamir, and we'll get straight to the point to present the private equity market for the year end. It can be summed up in one word, which is the market's recovery. But as you can see, in terms of the volume of buyouts in Europe in 2024, there were 271 billion of acquisitions. So compared with 200 billion in 2023, where we're not back to the figures of 2021, 2022, but we can clearly see a revival of activity in terms of investment. In terms of divestments, the M&A activity has also rebounded to 199 billion. But as I always remind you, there were two other engines that remained closed in 2024, namely IPOs. I mean, the IPO remained closed, but the debt market took off again, and there were quite a few recaps. Low pistons out of the three that worked in 2024. Against this backdrop, how did your company's Altamir perform? It is summarized on this page, i.e., that NAV, net asset value, grew by 1.4%, including the 3% dividend paid in May 2024. And that compares with 2.1 last year. So we're still in the low water in terms of growth in net asset value. On the other hand, the good news is the growth, the improvement in profitability, the EBITDA of our companies, which grew by 25.6% compared with 6.4% in 2023. So that's extremely encouraging, even in a market that's still difficult. Our divestment activity is very significant at the 332 million euros versus 24 million last year. 332 million euros, to put it in perspective, is exactly 20% of the portfolio, which totals 1.6 billion. So we divested, which is logical as we aim to rotate the portfolio over 5 years, 1/5 of the portfolio. So that's extremely satisfying. We made 8 new investments compared with 6 last year, amounting to 180 million versus 81 million last year. Okay, here again, if we take the idea that an investment should make twice its stake, when we invest 180 million, that corresponds to 360 million of expected exit price. So we are well on the right track. And the cash position at statutory level has clearly improved to minus 17 million compared with 43.2. But this figure of 18 million, does not include proceeds from the sale of companies which have not yet been finalized, such as Assured Partners and part of Cristal, and which have not yet been cashed in. Once these transactions are fully completed, we can expect a further strengthening of our financial position, reducing any short-term liquidity concerns. This positive momentum reinforces our overall strategy and confirms that we're moving in the right direction. We're on the 30th of December 2024. So if we zoom in on the amounts on the divestments, you can see on this chart, which traces 10 years of activity, that the year 2024 climbs to third place on the podium. On the podium in third place in relation to historical figures at 332 million, including 249 million in complete divestments of 12 companies and 83 million in additional investments. When I'd even say better than the market in terms of rebound. So how are these 332 million selling? Well, there are 249 million complete releases with the release of Europe Snacks, which we had held in the bottom 8 for almost 10 years. At 227 times our stake, the exit of Cristal at 2005 times our stake, which is a 2001 investment, but with reinvestment, as you'll see later. in terms of Apex 10 LP, 6 complete exits, Assured Partners, which has not yet been cashed in, Elphium, an Indian company. If we are looking to the multiples of investment they have completed, 205 times the stake for Assured Partners, 323 times the stake for Elphium, 323 times the stake in total for Picor, which has not yet been cashed in. The last exit, Baltic, classified for 2 times the stake. Gotai, which is a very small investment, and we've only recouped 30 cents of the amount invested. And Genius, 227 times the stake. We also received 84 million from 2 companies in the Apex Dix LP fund. Idealista, which was a reinvestment, I remind you, of the new fund. And we had already made 88 times our stake. And here we made 251 times our stake on the reinvestment, and Affinity Pay 82 times the amount invested. We also cashed in 2 sessions of the Apex Development Fund under very good conditions, 4 times the stake for one and almost 3 times the stake for the other. On the other hand, we recorded 2 total losses during the year, Antoria and Vaillard Medical, which were sold for the symbolic euro. We had a number of partial exits, the main one being the refinancing of Tom, which enabled us to repay part of the capital. This is why I said that the debt plunger worked, since you can see that Malink, Candela, Seat, Lexitas, Audido, and Safetree were refinanced in the form of dividends, allowing for a more efficient capital structure and improved financial flexibility so they can sustain their growth. Safetree, Safety Clean, and various other companies. So we're almost halfway through the refinancing of our portfolio companies. In terms of new investments, here again, you have a 10-year history. So we can see that at 180 million, we're in the right ballpark with 8 new investments and 46 million in additional investments in the portfolio. These new investments are described on the next page, page 17. Smith & Williamson is a British company specializing in tax and accounting consultancy. In fact, it's a classic chartered accountancy firm. So it's a carve out from a larger company. And Smith & Williamson was the historic name of this company. Very symbolic name in Great Britain, so we gave it back. As part of this carve out, we've given it back its origins, and they can focus on for their main business. The Project Viper is the merger of 2 companies, Veriforce and Alcumus. These 2 companies were merged on the same day. Alcumus was already in the portfolio of the Apex Fund 10, so it's quite an ambitious project. We have also Altus Fire and Safety, which is a plaid in the fire safety sector, an extremely fragmented market with plenty of build-up opportunities. A very interesting company. Full Guard, an Italian company, is in operation, this time with 7-2. And it's both a company in the same business as Altus Fire and Safety, which is fire protection, but which also has another component, medical control. The medical control in Italy, it's private companies, whereas in France, it's a public system of compulsory medical checkups. So that's what these 2 companies do. And here again, value creation is essentially based on build-up in the fire safety sector, which is also an extremely fragmented market in Italy. So Crystal is the reinvestment. We make 2.6 times the stake, and we reinvest 0.6 times, and it's in 13.7. It's the reinvestment of 0.6 times the stake. In Crystal, to continue this wonderful adventure, after reviewing the services companies which have been added to the portfolio, we are now talking about 3 new investments in the tech sector, reinforcing our commitment to high growth, innovation driven industries. Ici, Atsukima, Apex 11 invested in a company called Zelis, which supplies software for personnel and payroll management and in to every human resources tasks, and then in the profits the social benefits that are offered to employees. uh, as you know, ThoughtWorks is a very interesting operation. ThoughtWorks was a new fund investment that had performed extremely well since we had already realized 3 times our stake while the fund was still holding money in the capital. The company was listed on the stock exchange, and we took it off the market with the 11 fund. No, Apex 9 LP, along with the management team, practically owns the company's capital. Today, therefore, we have a significant reinvestment by the Fund 11, while the 9 fund retains its position. So there's a lot of work being done to management team. And finally, Lumion is an investment made by Apex 72, a Dutch company that has developed a real-time rendering software platform for architects, designers, and visualization professionals. So, another extremely promising company. In addition, there are the investments made through the funds. As you can see, 24 million have been invested through the Odyssey funds. Sorry, 24 million have been invested through the funds, i.e., the Odyssey funds. As you can see, 75% has been invested in Fund 21, 45% in Fund 22, and 19% in Fund 23. And so, on the other funds, we have invested 3.2 million through the Apex Digital 2 fund, which is also invested at 41%, and 4,100,000 through the Apex Dev fund, which is invested at 14%. And then there was only a small correction to take account of the actual amounts invested compared with those estimated in the presentation we had previously made. In addition to these new investments of 135 million, there are 46 million in additional investments, which we have broken down into what we called offensive investments in Vida Protect to make a transforming acquisition in the United States, in Infraneo to make acquisitions, and in Odigo, Palex, and On-Course Home Solutions. And then 2,600,000 in a variety of different companies. And then we invested 5.4 million to strengthen InfoVista's solution and financial situation, which I'll say a word after, is now on the road to recovery. 4,600,000 in Mental Better, which is also a sign of improvement. On the other hand, we have invested 2 to 3 million in heating recovery services, which we are going to lose as an investment, with what was previously invested and what we have invested here. And then there were 9 to 7 million for ThoughtWorks and Inmarsat, which were refinanced, and so on. So all this translates into growth of 124% in net asset value. As you can see, revalued net assets at 31/2024 is 3506. By way of comparison, it has obviously been falling since 2021. Since in 2021, we were at 37.81 euros and are now at 35.06 euros, in 2.75 euros less than the peak of 2021. But these 2.75 euros less are offset by the fact that we paid out a dividend of 113 in 22, 108 in 23, 108 in 24, 216, 316, 329. So we paid a dividend of 3.29 euros for a drop in NAV of 2.75 euros. So the portfolio actually performed extremely well during this period. since the portfolio enabled us to cover dividends, but also to cover, as you will see in a moment, all direct and underlying costs. So I think we will in the future bounce back from these movements. We'll move on to bridge, and I'll give the floor to Eric Sabia, our Chief Financial Officer, to comment on this change in net asset value.
Thank you, Maurice. Indeed, as Maurice has just described, there are two reasons for the change from NAV at end December to now at end December. It's the value creation on the first part of the graph with 73 million in value creation over the year, but mainly driven by capital gains realized on portfolio sessions, 53 million euros, and also a little by the revaluation of companies still in the portfolio. Unfortunately, this value creation does not compensate for the rest of the graph on the left, the expenses and the dividend. If we set aside the dividend, the value creation covers the expenses, which are just over 43 million euros plus 9.7 million euros in financial expenses. But the 20 million euro difference between the 31 2024 and the 31 2023 is explained by the 40 million euro dividend paid over the year. Turning to the next page, we give you a breakdown of value creation by sector this time. Here we see that we are being driven very strongly by the tech and telco sector, by the consumer sector and the service sector, while the healthcare sector is in decline. The two messages I'd like to pass on from this graph are the losses. The fact that despite this 73 million in value creation, we had three losses over the year, which, as Maurice mentioned a little earlier, are Antoria in Weiler and Eating Recovery Center, two companies in the healthcare sector, and a service company which would otherwise have created value. Well, if we weren't concerned, this loss of value would have created 122 million in value creation instead of the 73 we recorded.
So I'd just like to point out here that, as you can see, the healthcare sector underperformed quite significantly, and this has led both Apax 7.2 and Apax LP to decide not to invest in the healthcare sector in the future, with the obvious exception of activities like services directly linked with hospitals, or also distribution activities in the healthcare sector, or software activities in the healthcare sector, which will be dealt with either at the service or tech level. But the healthcare sector itself will no longer form part of the investments made by either Apax, LLP, or 7.2. This strategic shift reflects a reallocation of resources towards sectors with higher growth potential. On the other hand, in the Altaroc funds, among the managers we select, we have a fairly significant exposure, let's say at least 10% in the healthcare sector. So we will remain present in the healthcare sector, but through the Altaroc funds. That's all. Thank you. Excuse me, Eric.
Right away. It's now on page 23. We show you the different value creation levels used by the managers in your portfolio to create value at portfolio level. We can see that, as is the case almost every time, most of the value creation came from EBITDA growth, which was effectively offset by a significant drop in multiples over the last 2024 years. And we're not going to dwell on the figures because there were several complex operations carried out by both the Apex funds and the LP by the 7 funds. It all adds to the complexity of the reading. On the right, you can see the change in portfolio value from the end of December 23 to the end of December 24, and that overall our portfolio remains stable. We carried out many sessions, many investments over the year, and the creation of value of 1922 million euros offsets the very slight decline in a portfolio that is really stable over the year. The previous slide showed the change in the portfolio at fair market value. We'll now zoom in on the portfolio at cost. We can see that our portfolio at cost has grown from 982 to 1,080,000,000, so an increase of 10% over the year, while at the same time our social welfare situation grew by only 3%. It's an indicator that we follow quite closely as we try to invest as much as possible. And we can see that today our portfolio represents more than 117% of the welfare situation. This is a very interesting indicator that we follow like milk on the fire. On the next page 25, we show you the different ways of valuing the portfolio, either using comparables or recent transactions, or whether the companies are at cost or valued according to their stock market price. We can see that today only 2% of the portfolio, which are represented by listed companies, mainly OpenLane and Pecor. And this figure is set to fall as we still have listed companies in the portfolio today at December 31st, which are due to exit at the beginning of the year. Next slide, we present the uplift. Uplift, I remind you, is the difference between the valuation at which we sell assets in a given year and the value at which these assets were held prior to the Giant's decision to sell. We can see that uplift, as has historically been the case, remained positive for 2024 because it includes many disposals, Crystal, Europe Snacks, and we have nonetheless included two companies in this uplift, Antoria and Vayer, which even though they are still present in the portfolio at December 31st, since we know we are going to lose them, we have already included them in the uplift of 2024. So even though these companies have already been anticipated in terms of uplift, we are maintaining a positive uplift for 2024. Right now, we present Altamir's residual commitments at the end of December. We still have 500 million euros of residual commitments at the end of December, of which 123 million euros have already been committed by the funds in our portfolio. I would remind you that the use of credit facilities by the funds gives us visibility on future disbursements. The 123 million euros have already been invested out of these 502 million, which are divided between the three allocations shown on the rest of the slide. Mainly, as can be seen in the allocation of 2023 to the XILP fund, and in 2019 on the 7210 LP fund. In terms of cash, we have a cash position, as Maurice was saying, which has improved over 2024, especially as it does not take into account at the end of December a certain number of sessions which have been completed, but for which the receipt of proceeds will be spread over the beginning of 2025. And we have a cash position in the corporate accounts of less than 7 million euros. We have compositions, which I've given you a little lower down on the slide, and an IFRS cash position that is broadly stable compared with 2023 at less than 186 million euros. It's also important to mention that as at the end of 2023, we still have 135 million euros in credit lines. We regularly work on extending or renewing them, and we have renewed them in 2024 and even in early 2025, a certain number of credit lines.
Thank you very much, Eric. So we're on page 29 for significant events. We can confirm that our portfolio has no significant exposure to Russia or Ukraine. The only new post-closing information is the fact that the Apax fund has announced an investment in Kohn Resnick, which is also an accounting, tax, etc. firm in the United States. And so it's a significant firm with 29 offices employing over 5,000 people and 330 partners. And so once again, we consider that this is an extremely fragmented market in the United States. And once again, we have the opportunity to create a major leader in a sector that is extremely recurrent. So this market, then we come to the most important thing, since I say every year that the value of your company is the value of its portfolio. So you can see on page 31 that the portfolio at the end of December 2024 comprised 67 companies for 1,625 million. When we say 67 companies, we mean the companies we individually. Because in the Alterac funds 21, 22, 23, Apex Digital 1 and 2, and Apex Development, we have hundreds of companies. So we don't communicate on all these companies, but in reality, the portfolio. So of course, for amounts invested, if I add up 3.5% in Odyssey, 1% in Digital 1 and 2, and Apex Development, 1.3, that makes 3.23, that makes 5.8%. So for that 5.8%, we have 6%. but we have hundreds of companies. But when we talk about 67, it's in the other 94%, which breaks down into 21% in direct co-investment and 75% via the 7-2 and Apex funds. The portfolio, as you can see on page 32, is well low balanced in terms of here we're in a fair market value, like we're not in costes. The portfolio is 53% in tech, 26% in services, 17% in consumers, and 4% in healthcare. By vintage. Since vintage is important in the sense that it's what gives a bit of the exit potential, and so you can see that what's in gray and pale pink represents around 30% of the capital, which are the potential sessions we're expecting over the next 12 to 18 months. And by geography, I'll answer that we're 70% in Europe, 23% in the US, and 7% in the rest of the world. Most of our companies nowadays have a strong international presence. For instance, take Marlink as an example. It is a truly global company with a wide reach, covering around 70% of the market. It holds a significant position in the United States as well as other parts of the world. But our portfolio is well diversified geographically. So, as you know, Altamir's philosophy is to invest in growth companies. And for us, growth means EBITDA growth, which is why for years now, we've been showing you the EBITDA growth of our portfolio companies compared with the 35 or 36 companies in the CRC 40, the non-financial companies in the CRC 40. And you can see that in 22 and 23, we had underperformed the CAC 40 companies, whereas historically we had significantly outperformed the CAC 40. We had significantly outperformed the CAC 40. You can see that in 24, we've very significantly gone back in the right direction. Then we'll give you a bit more flesh. 37 companies that represented 67% of the portfolio at cost and 81% of the portfolio at fair market value. Some of them by more than 20%, etc. So overall, the portfolio is in good shape. In terms of EBITDA growth, you have more or less similar figures. 75% of companies at cost and 86% at fair market value have EBITDA growth, which explains the 26% growth in average blinded sales. And you can see that 40% of them have grown by more than 20%. So, on the other hand, if we have EBITDA growth, we've had a significant drop in multiples. You can see that we're almost back to the 2021 level, which is more and more tech-oriented and more growth-oriented. So this 13.6 multiple is really very conservative. On the other hand, you can see that the level of debt remains, the leverage remains around close to 6. So there you have it, but driven by a few companies that were over-indebted. So there you have it. But today we don't have, apart from the companies we've lost, the problems have materialized. Antoria, for example, weighs enormously, weighs on the multiple, whereas Antoria is the debt multiple, whereas Antoria is lost. So we'll be reviewing the next reporting when Antoria is out of the portfolio. We'll see this multiple return to much more significant levels. We then presented the 20 main investments, which account for 68% of the portfolio's market value. And as you can see here, These 20 investments have a residual cost of 677 million for a valuation of 1,100,000,000, and they are all marked above cost, with the exception of Infovista and Mental Better, which are slightly below the cost, and I'll come back to that later. So, if you don't mind, I'm going to comment on the performance of each of these 20 portfolio companies. Staying in the tech sector first, Destiny, as you know, is a major European player in on-demand unified communications, or UCaaS. So the company continued to perform very well in terms of sales and EBITDA growth, and continued its international deployment by penetrating the German market with a first acquisition in the German market. And what's also interesting to note is that although overall sales have only risen by 3.5%, the software division, which is the most valuable, is growing at 10% a year. Greatech is an international publisher and distributor of BIM, Building Information Modeling software for design, calculation, simulation, manufacturing, and collaborative management. Here again, Greatech had a very, very good year, both organically and in terms of sales. And through external growth, now so the company is rolling out its digital transformation plan. And so today is the world's leading Autodesk reseller. And so it's an extremely successful company in our portfolio. As for Marlink, as you know, we've had it in our portfolio for a very long time, and it's a world leader in satellite communication services, mainly in maritime and remote land areas. Here again, the company's performance has been absolutely remarkable, above all with several acquisitions. On the other hand, you will see that Marlink sees its valuation going down at the end of the year. The reason for this is that to create liquidity, Marlink will be transferred with part of Cristal into a continuation fund. Which is being acquired by secondary funds, and therefore the decline in Marlink's valuation is not at all related to its activity or the decrease in comparable multiples, but rather to the need to create liquidity for the funds. As a result, Altamir is present in Marlink through funds 8 and 9, and we will therefore sell our shares. However, we are also invested in Marlink through co-investment, and here a decision needs to be made. We will most likely reinvest and retain a significant portion of Marlink. This approach ensures continuity in our involvement while allowing us to benefit from future value creation within the company. As far as Odin is concerned, it's one of the Netherlands' leading providers of outsourced cloud-operated IT services. After a rather slow start, you can see that Odin, thanks to acquisitions and improved management, Odin is performing very well during the year 2024, especially in its, how can I say that, in its core business. So there you have it, a very fine performance from Odin. Odigo, let me remind you that the Odigo model, first of all, is the leading provider of contact center as a service solutions, mainly for large enterprises. Odigo's investment thesis, which was essentially, I'd say, was to transform the entire business into SaaS. So it took longer than expected to do it. It cost longer, it cost more, and so on. But this operation has now been completed. The move to SaaS has been made, and thanks to this, you're seeing very significant growth in EBITDA, since the switch to SaaS has enabled us to significantly reduce costs. On the other hand, the price we had to pay was a lower sales achievement, and the management team's main priority now is to restore sales growth while continuing to improve cost. Vitaprotech is therefore a French leader in premium electronic security for sensitive sites with high security requirements. and in security needs. Today, therefore, the most striking phenomenon is the acquisition of the American leader, which has enabled the company to practically double in size by being on both sides of the Atlantic. On the other hand, the company had to face, I would say, an unfavorable environment, which translated into a drop in organic sales and EBITDA. But a very strong action is being taken to rectify the situation. Still in the tech and telco sector, Infovista is a world leader in software solutions for improving network performance. I would remind you that Infovista, which we have globalized through a series of acquisitions, has also had to contend with an extremely negative tech and telco market over the last 2 or 3 years, as has ThoughtWorks. As a result, the company had to completely change its management team and embark on a major cost-cutting strategy. But you can see that the turnaround is underway, and that today, for the financial year ending July 2021, the company hopes to be in line with its budget and with positive EBITDA. In addition, the company has renegotiated its debts and is now up and running with a management team in place, business recovery. We're hoping for an upturn in business. Experio is a major player in managed internet access connectivity worldwide. And here again, Experio's approach has involved circumventing telecom operators and instead selling directly to companies, thus increasing profit margins. Additionally, Experio has targeted the lucrative US market to further enhance their business strategy and increase their growth. At first, telecom operators reacted slowly, but then, seeing Experio's success, they reacted more sharply. So the reason why we're seeing a slight decline in sales and EBITDA is that growth in direct business is not fully offsetting the fall in business with telcos. But as this share continues to shrink significantly, the curves will cross. What's more, a new manager has been appointed from the inside. We're still in tech and telco, which is clearly out of the 20 companies. How many do they represent? They represent 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. There are 10 out of the 20. They're in the top 20, so to speak. And here again, let me remind you that a European leader in CRM software, the company following the appointment of a new manager has really taken off, as you can see, with an 80% growth in its sales of 1 and then a slight decrease in its sales of 2. A slight decrease in sales with 2 businesses not working in the same direction, but again, all's well. As I explained earlier, ThoughtWorks will once again be a significant investment in our portfolio, as we will be holding it through the 9 LP fund, the 11 LP fund, and we have a co-investment in this company. Here again, our exit from the stock market means that we'll be putting in place a new management team, a much more aggressive strategy in terms of winning new customers, and a much more aggressive strategy in terms of cutting costs. In other words, a very ambitious plan to create value away from the stock market. So we're transitioning from the tech and telco sectors, which represents 10 out of 20, to the services sector. In this sector, we're returning to things that are much more tangible or drinkable with AEB. Our focus is now on the services sector, where we will delve into offerings that are more practical or consumable, combining AEB. Wine and beer, to be clear. Here too, the company is facing a wine production market production market, which is shrinking significantly in all territories, and AEB has to face this problem. Nevertheless, the company has managed to maintain its sales and throughput. And a new one, the company has refocused by selling off somewhat external activities, and a new manager is in place. Optiven is one of Europe's leading providers of motor insurance products and services. When your car breaks down on the ring road, well, if you're an Optiven member, that's where we come to help you out, and so on. So the company is off to a very good start with gross margin and EBITDA growth of over 20%, and is pursuing its inter-European expansion strategy with acquisitions in Italy and Germany. These developments further strengthen its market position and lay the foundation for sustained long-term growth across key European regions. And of course, by strengthening its management team to cope with this strong growth. Cristal, well, as you know, because we have this company for years, was one of France's leading in asset management consulting, and under the leadership of 7-2, the company made over 20 acquisitions, including 3 or 4 extremely transforming ones, such as Primonial, which enabled us to more than triple our sales and profitability. The company was sold in October to Goldman Sachs and 7-2. 7-2 decided to reinvest in this company alongside them. That's it. And Cristal as well will be part of the continuation fund, which will have Marlink. So we'll have, in the future, Altamir will have 2 feet in Cristal, one through the Apex 10 mid-market fund, 7-2, and through the fund at the level of our co-invest through the continuation fund, which will include Marlink, alongside Cristal, so we can still benefit from the growth of these companies. So Fulgard, as I said earlier, is a leading player in the fire safety sector. It's a new investment made by 7-2 with a very, very important objective of growth through acquisition and build-up. That's it. Still in services, PIB Group is a leading UK-based insurance brokerage firm with a presence in continental Europe. Here too, it's a buy and build story with a very significant number of acquisitions under the leadership of Apex LLP, resulting in growth in sales and EBITDA. And in particular, the company, which was essentially UK-based, is now pan-European with sales in continental Europe. The scenario regarding partner selection follows a similar narrative, albeit with a domestic focus in the United States. The selection process will be finalized in the upcoming days, as it was recently put up for sale during the end of the year. And here again, the value of the choice of partners, which is up, is down on that of 2023, both to take account of the fact of the session, since a choice of partner, simply to situate the debate, is a $16 billion session that was sold to an industrialist in the sector. But to sell a $16 billion asset, we had to take a slight discount compared with the last valuation in our books. So there you have it. We end on an investment. Oh yes, sorry, I'm still in services. Infraneo, excuse me. Infraneo is a leader in the field of infrastructure, providing mission inspection, diagnoses, and recommendations for companies in this sector. The company has continued to make acquisitions, and you can see that its sales have already doubled since the investment, which dates back no more than 12 months. 12 months ago in 7.2's portfolio. So here again, we have high expectations for this project. And finally, Project Viper is a global benchmark in the provision of integrated solutions and services dedicated to supply chain risk management. What does this vocabulary mean? This vocabulary means that in reality today, when you're a large group and you want to, I don't know, build a factory or construct a new building, etc., you need to call on the services of a specialist. Well, you have to call on subcontractors, but you have to calibrate the quality of these subcontractors in terms of regulations, safety, their employees, etc. And what does this company do? Well, it organizes a network of subcontractors that it validates and certifies, etc., on behalf of major contractors. Project Viper is built to be a leader in his sector. So finally, Project Viper is the combination of two companies, a new company called Veriforce and an Alcumus company, which was already in the new portfolio and which will both be merged with the understanding that the new fund will return its share of the investment in Project Viper. So we'll have this Project Viper through Fund 9 and through Fund 11. That's why it's making a brilliant entry into the top 20. We only have two investments left, one in the consumer sector and one in the healthcare sector. So Tom is the company. Tom is, as you know, Histoire d'Or Marco Rion. It's in Italy, Eurovivo, and in Italy, Stroning. So the company, which ended its financial year on September 30th, has seen its sales grow by 4.5 times and its EBITDA by 2.5 times. This is an absolutely remarkable performance, given that the market is in steep decline. On the other hand, the price of gold has risen by 40%, and we are not reflecting this. We don't pass on the increase in the price of gold. This costs us around 15 million in EBITDA losses every year. But we are gaining market share. In addition, as you know, we carried out a secondary financing at the beginning of the year 2024, which enabled us to recover 60 million euros in the form of dividends and redemption of our cost. And so of the 100 million we had originally invested, our 100 million was fully recovered 3 years after our initial investment. And Tom is still valued at more than twice the stake on the remainder. Now, finally, the last investment is Mental Better in the healthcare sector. Mental Better is a Dutch provider of outpatient care for mild to moderately severe mental health disorders. It's the same business as heating recovery services in the United States. However, here, the recovery is going better. And so you can see that EBITDA and business scale are in sight, despite still a lack of therapists and extremely painful wage inflation. Nevertheless, Mental Better is now valued at almost 60 or 70% of its cost. We therefore hope that the company will continue its recovery. So this covers the 20 main investments of the portfolio. So what does all this translate into? Well, in terms of NAV, you can see that after 3 lean years, our theory has fallen to 11.4% over the last 10 years. We are still outperforming our benchmarks by 2 points. Over 5 years, however, we're on a par with our peers, and obviously over 3.5 years, we're lagging behind. But I hope we'll get back on track. And as far as the dividend is concerned, we still have our policy of paying 3% of the net asset value dividend as at December 31st. So we're going to propose to the board. The board will decide the future amount of dividend, which it will submit to the annual general meeting. And so on the other hand, in terms of total shareholder either, which includes both the evolution of the share price and the dividend that is paid, you can see that here again, we are outperforming our peers and even the cap mid and small over the whole period. And so what we're obviously tracking is the performance of buyout transactions since Altamir's creation. And you can see that after computing cash flows from every year, we've invested 2.5 billion since day one, with a multiple of 182 and an IRR of 15%. So that the fully realized portfolio, the portfolio between half and half, it's absolutely extraordinary. Between the realized portfolio and the unrealized portfolio. On the realized side, we're doing better than average. We're doing a 92, but it's 14.26 in theory. And on the unrealized side, which is normal, we're doing 1.7, but 16.9 in theory. So that's quite promising. Finally, I had indicated in 2001 our objectives for the next 5 years, by knowing that we wanted to invest an average of 170 million per year. And so you can see that we had invested 38 million in 23, but 181 in 2084. And when you add up the 4 years, we're at 204 compared with 170. So it's not going to take much to meet the 5-year target. In terms of divestments, we were aiming for an average of 230 million. And here again, after 12 million, which could have been frightening in 2083, we have 333 in 2084, which show that this is a cyclical business. It's not linear. It's our business. It's a cyclical business. And so we're at 269 over 4 years. So here again, we're at 269 over 4 years. So here again, we're well within our targets. And in terms of organic EBITDA growth of 7%, with a poor 124 in 2023, we're bouncing back strongly, but that includes the 25.6. It includes extra organic growth, and we're at 17% all told. So we're on target. So in conclusion, as I tell you every year, why invest in Altamir? Because it's a unique value proposition that enables us to, gives us access to impact fund investments worldwide. Then our strategy is focused on growth, both in net asset value and long-term growth. In that our total shareholder return offers a return of 4 to 5% a year, double-digit shareholder return growth, and that the entry point today is still very attractive with a discount of around 30%. And that we have an intrinsic profile, a portfolio built over the years, diversified by sector, geography, leverage, and so on. An experienced management team and a highly efficient tax model. So thank you for your attention. Claire and Eric, join me in thanking you for your loyalty. And we look forward to seeing you in 6 months' time.
Thank you and goodbye.